Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference, and I'm here with Ervin, who's the president and CEO of Reality Shares. Great seeing you, Eric.
Hey, Tom, thanks for having me. Yeah.
You folks just launched a suite of dividend-oriented ETFs, but there's a great strategies around them. Tell us about it.
Yeah, if you think about Reality Shares, we are all about dividend growth. We know that the dividends are real. You can't fake a dividend, and dividend growth is really a signal of dividend health, company's health, stock performance, everything all the way down to just the corporate performance. So our first ETF, Divvy, was isolating that dividend
DIV.
growth. DIVY,
right.
Which is the first ETF of its kind that isolates the growth of dividends without any stock market exposure. These new funds are really stock-based, but they have a different twist. So we've developed a model to predict which companies are going to increase their dividends and which companies are going to cut. We have three new funds. One of them is long only. It's on the leaders, the companies most likely to increase their dividends in the next 12 months.
Right.
And then the other two are varying amounts of a hedge on whether or not you're long those leaders and short the laggards.
Those that are going to cut.
Yeah.
So it's a long, short type strategy with dividend-oriented.
Yep.
Oh, great. Okay.
Very defensive. If you think about just, even if you just avoid the cutters, you can outperform the market. Just that simple act alone is if you can predict which companies are going to cut and avoid them, you outperform. But if you can actually short those positions, you end up taking a lot of the risk out of the overall other part of the portfolio, and you end up with a really defensive nature to it.
So you have inherent analysis of dividend-oriented stocks within the index, correct?
Yep.
How often is this reconstituted?
Once a year. So what we found was that the value added by rebalancing more often really didn't add that much extra value because companies tend to not change too much in terms of the health of the business.
Yeah.
So if you reconstitute once a year from the number of holdings and the names, and you end up with a turnover of around 40% in that index.
So company's healthy, continues to be healthy each year, stays in there.
Yep.
Looks like it's not healthy, something's going on. It could be on the dividend cutters list, and you could actually be short. Is that right?
Yeah, exactly right. The two strategies that are long short, Defender, DFND, is 75% long, 25% short, very constant at all times.
Yeah.
The other one is dynamic. So we all know stocks generally go up, and why fight that trend?
Right.
But there are times when, almost like a check engine light, when market risks are elevated, and it's at those times that GARD portfolio, GARD, will go to a long and short position and hedge. Excellent. Incidentally, right now it is hedged because it's signaling that markets have probably a little bit more risk in the future. So very defensive in that one.
Interesting.
Yeah.
Well, we'll tune in again soon.
Yeah.
But in the meantime, congratulations. Great seeing you, Eric.
Thank you, Tom.
Thank you.
Thank you very much.